I got so many requests to do an analysis on FICO stock. The stock is one of the highest quality companies in the world. It had a monopoly for many, many decades. And now the stock is down 29% year to date. It used to trade at 80 times forward earnings, 80 times, and now the stock is trading at 25 times earnings. And this is why I say it's not about what we buy, it's what we pay. Even if you buy the highest quality company in the world, if you pay too much for this quality company, you could still end up losing money. This is what happened to FICO. But FICO over here is much better valued than it was at 80 times forward earnings. So this is an amazing time to talk about the stock and give you my opinion, talk about the risk, and give you my fair value and upside potential. So I really hope you enjoy it as always. Now, FICO makes money from two different ways. The first one is the software revenues, which isn't growing a lot, 8%, 2%, 0%, 2%. It's not really growing a lot. But the main business of FICO, which is where they generate 80% of their profit, is through the popular FICO score. And FICO score is a score that we all pretty much need in the United States. If you want to buy a house, if you want to buy a car, they all check your FICO score. And FICO had the monopoly on it for many, many decades. And this is the fastest growing piece of the business, growing at 29%, 25, 34, massive, massive growth for this segment. Now, very recently, the director of housing, I believe that's how you call him, he decided that FICO pretty much has a monopoly, and FICO was kind of price gouging the customers whenever they're going to buy a house, and it was costing the customers a lot of money whenever they're just going to get a loan. So he wanted to introduce more competition, and he decided to do that by allowing Fannie Mae and Freddie Mac, which are somewhat of government agencies, to allow lenders to use Vantage 4.0. And now FICO is no longer a monopoly. And this is not the only score that you could use. You could also use Vantage. And that has affected the sentiment around FICO a lot. It has not affected the financials. It has affected the sentiment. Now, the whole argument around increasing competition is really, really stupid because, yes, FICO has increased the prices of their scores over the last few years. But how much do you think the price of a FICO score is? Maybe $50, $100, maybe $200? Well, it's only $4.95. This is how much FICO is getting, $4.95. It used to be 60 cents. They did increase it since 2018. But $4.95 is not going to make a difference based on if someone is buying a house or not. So this is more of a biased solution to say they're doing something instead of actually doing something about home prices and affordability in general. Now, very recently, TransUnion, they decided to lower the price of the Vantage score for mortgage origination to only 99 cents. So this is massive competition right now where you can use the Vantage for 99 cents or you could pay up $5 for FICO. And most of the revenue growth for the FICO score has been coming in through increasing prices. So this is going to limit the amount of price increases that FICO could put up because you could always get the Vantage score for 99 cents. And now there's not a big difference between, let's say, $1 and $5. But if FICO is planning to increase the score to $10 or $20, if TransUnion keeps it at 99 cents, then that could affect FICO's ability to raise prices and it could start to introduce more and more competition. So some of the decline in FICO stock, in my opinion, is justified because the stock used to trade at like 80 or 85 times earnings at 2,200. It deserved to go down. And I'm going to talk about that a little bit more. But Vantage Score is not the only competition that FICO is facing. It's also facing competition from Upstart and other credit agencies and credit origination companies that are using AI and they're using their own models to come up with a risk profile instead of them using FICO. And this is one of the biggest risks outside of the Vantage Score. And this is an article from Morningstar, which they did a lot of deep research on. and you're going to enjoy reading what I'm about to tell you here. And it says, we believe there are two main use cases for the FICO score. The first one is an underwriting decision for an individual loan. So this is where they use the score to determine if they're approved or you're not approved. The second use for FICO is in benchmarking for credit quality. Now, Morningstar, which they assess the moats of a lot of companies, they don't believe the underwriting side of the business has any particular moat, because companies like Capital One are using an information-based strategy. So they're not really using the FICO score. Affirm is using their own models. Even Upstart has been saying that some of its lender partners have eliminated FICO score requirements. So this is not where the moat of the FICO score actually is. The moat of the FICO score is mainly in benchmarking, and they call it a wide moat, because even if loans are not underwritten using FICO scores, originators still use FICO score as a way of communicating their credit quality. For example, in 2014, CarMax disclosed the auto financing unit. The FICO scores are not a significant factor in choosing the risk models. They don't even use FICO scores a lot to determine if you're approved or if you're not approved. But despite that, the firm's latest car loan-backed asset-backed securities, which is a market on the market, they also reference a weighted average FICO score, which means the utilization of the product is effectively unavoidable. So I'm going to try to keep it simple. And if, let's say, CarMax wants to approve you for a car loan, maybe they don't need to use FICO score to know if you're approved or not. But if they want to compare their own risk model of how they assessed your risk model, if they want to compare the accuracy of it, they still have to use a FICO score, especially if they want to sell those loans to third parties and private credit companies and other companies, because they don't want to hold them on the balance sheet. If they want to sell them, those other companies are not going to accept CarMax's own risk profile to determine if those loans are good or bad or what is the credit quality. They still have to give them an average FICO score, which means even if they use their own model to approve people, they still have to use FICO score for benchmarking against their own credit model, which means they still have to use the FICO score. So this is as simple as I could do it, and that really explains it really, really well. Now, they also have a software business. The software business is 20% of the profits, and this is mainly workflow for account origination, fraud detection, other kind of things, and they believe it has a narrow moat, mainly based on switching costs, because they have competition from Experian, Equifax, and Moody's. And this is pretty much a no-growth business. But this is an amazing article from Morningstar where it explains where the moat is. The moat is not in underwriting and using FICO score, is mainly in benchmarking their own profile. Maybe they use AI to come up with decisions, but if they want to sell those loans on the open market, or if they want to do anything with them, they have to compare their AI-based decision relative to the average FICO score of those people, because other kind of agencies, they will only accept the FICO score. And this is an amazing way to look into it. And by the way, I'm using fiscal.ai to come up with all those charts and to even get the free Morningstar report, which you get for free. If you use my link in the description, you get 2 weeks of free access. And I've been using it more and more often, and it's very, very beneficial. But very recently, the management has indicated to us that they believe the stock is undervalued. They issued $1 billion of a, you could say, specific bond or a specific loan for 6.2%. That's due in 2034. And mainly they want to repay $400 million out of the loan that's due next year at 5.2%, and they want to use the remaining $600 million for share repurchases because they believe the stock is getting undervalued. Now, we did look at FICO, and I believe there's a lot of risks. The first one is the Vantage score at 99 cents. That's going to limit FICO's potential to increase prices a little bit more. They can still increase prices, they can benefit from more volume, but still, that's going to hurt the business model a little bit. And of course, it doesn't deserve 68 times earnings, which is why in my valuation model, I'm using a little bit more of conservative estimates. If we look at the analyst estimates, they're expecting 40% growth in 2026, then 27%, then 19%. I'm using a little bit more conservative estimates. I'm using 40% for 2026 because they already put in the price increases for them. So the 40% is highly likely going to come in. After that, I'm using 20%, 20%, 15%, 15%. I believe this is fair. The trailing PE right now is about 48 times earnings. So this is how expensive the stock is. It's trading at 48 times trailing earnings. I took it from 48 times to 25 times earnings. And this is also due to FICO having a very high net income margin. So they have like 35% net income margin. It's a really good business in general. So I'm using 25 times earnings. I believe it's fair. I'm getting a share price of $1,991. So for me to get it double over the next 5 years, or more than a 12% return, about a 15% annual return, I would have to buy FICO at about $1,000 per share. And this has been my price target all along, even from July 8th of 2025. I said FICO is an amazing company trading at a ridiculously expensive price. To me, it was just obvious. And a lot of people were trying to justify why, because it's a quality company and all of that. But the truth is it was expensive. I said my fair value is $1,000. It's still $1,000. So I believe FICO over here is getting extremely attractive in my opinion, especially if it gets back to the low of 20, 21, 22 times earnings. That would be around $1,000. I don't think the business is going anywhere. I believe there's some risks from Vantage. It could put a ceiling on price increases, but you also have to remember that FICO started raising prices in 2018. Before 2018, the company used to grow in earnings 15 and 20%. So I'm not seeing why they can't grow 15 to 20%, even with the Vantage risk or the AI risks. And based on those assumptions, I'm getting about $1,000 per share to get a 15% annual return, or a double over the next 5 years. And that was my opinion on FICO. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.